In this analysis, we will look at three value stocks that could potentially yield a nice return with relatively lower risk. None other than Warren Buffett became wealthy thanks to investing in value stocks. This was still in his early years under the guidance of Benjamin Graham, who of course was raised in a completely different situation, namely the economic depression, and he was very cautious. So what he did was mainly buy companies that are worth much less than in reality. Well, it sounds a bit strange, but you should actually think of it like if you once bought a piece of land a long time ago and it's listed for $25,000 on the balance sheet, but 30 years later, that piece of land is, of course, no longer worth $25,000, but for example, 10 times that amount. Now, the best examples of value stocks have not really been easy to find for quite some time. Warren Buffett also bought what they called cigar butts, or companies that had one last puff in them, and then he could comfortably extract cash and still achieve returns on his investments. But nowadays, there is more competition, and information is much more readily available online, of course, to a much larger audience. So finding true bargains is particularly difficult. It only works if you really have industry expertise. Now, in this video, we have selected three stocks that caught our attention. And actually, what you should definitely do yourself is determine the intrinsic values, but we apply a trick here. Namely, in the short term, it's somewhat easier to estimate whether a company is possibly undervalued, yes or no, than in the long term. Now, the correct methodology to determine intrinsic values, that means what a company is truly worth, is to sum up the future cash flows and discount them at a certain interest rate due to the level of risk. Then you get what they call a discounted cash flow. I also have an Excel for that, which I will make available on Happy Investors on our website. There you will also find more free downloads, such as an ETF book with ready-to-use strategies, a stock book with our methodology on how we select stocks, and some other things that you can download for free. But this discounted cash flow methodology does take some time, not so much filling in that Excel sheet, but on such a name. And maybe the second part you always have to do is determining scenarios. You can expect a certain pattern, but you also have to consider a worst case and a best case scenario, of course. And based on that, you have to make a decision. But the true power of discounted cash flow lies, of course, in how well you know the company and how well you can estimate what it will generate in terms of cash flow in the future. That is the real trick of value investing. The three stocks we have selected are a kind of mix. First of all, we have followed them for a longer period, so we know the company somewhat in terms of content, but we are not industry experts. It is important to emphasize that you must have a good understanding yourself and keep it within your circle of competence, because that's where the big opportunities lie. But these stocks, for whatever reason, have all declined for a longer period and are now starting to enter an upward spiral again. So the experiment we are applying now is to look at a bit of factor analysis in the short term. They already have cheap stocks, but the question is whether they will generate more profit in the short term. What it does in the long term is irrelevant for now, because in the short term you can already make a profit just by using this method, but you have to be sure that it is correct. What you certainly don't want is a temporary revival. So we have made a shift. Of course, we analyze thousands of stocks every week for days on end. That is what we do. And these three companies all certainly have long-term potential, but to what extent? That is the real question for the long-term investor. So this is an inspirational video based on factor analysis of these three interesting value stocks that could have potential at least for the next 6 to 12 months. Let's take a closer look. The first example of a value stock we currently see is Aptiv Holdings. This company has the potential for an average return of about 30% per year for the next 3 years. Let's say it underperforms, then it might be around 10% and probably with relatively lower risk. The reason this company's stock price has fallen so much is due to the entire automotive industry being significantly affected. And yes, of course, that is already a cyclical industry by definition. Well, Aptiv Holdings actually creates both hardware and software for this industry. So they do a number of things, and quite extensively too. And I have followed TIFF for a long time, even at the bottom, and I will show you that shortly. I decided not to buy, even when the price to earnings ratio was around 6, exceptionally low. And management also indicated, hey, we're going to buy back billions in shares. However, I decided not to buy because I found it intentional, but I simply lack a bit of substantive knowledge. And unfortunately, I've burned my hands too often investing in sectors where I don't have much understanding. Now you might think, how much knowledge do you need about the automotive industry? After all, they are just cars, but I think differently. This is a cyclical industry, so be careful with what you do, But an advantage of Aptiv is that they have naturally multiple customers, so they are spread across the entire industry. And the CEO, Kevin Clark, has been in service for a long time. He has been the CEO since 2015. He has also indicated several times that he would buy back shares through the company, and the latest figures were not great. But you could also say that yes, the expectations were so low that it might even be slightly above expectations. So we also see that the stock price is now starting to rise since DAL, which I have been following for some time. But it is a complex case, I must say, because the revenue growth seems to be a bit disappointing. Still, we see that the earnings per share, which is ultimately what matters to investors, are starting to rise. This is partly due to increased profits, but also due to some share buyback programs. Well, there are a number of things you need to remember, and you should definitely research the latest figures thoroughly, but especially the long-term strategy. It's also important to know that bookings are decreasing somewhat, at least compared to 2022 and 2023. So there seems to be stagnation here, but this could also be related to the overall cyclical market. And moreover, there's also something like China, of course, which makes cars at much lower costs. There are really good cars, Li Auto, Bid, you name them, Neo, all good companies. Setting aside what their stock prices are doing, an Aptiv Motive or Aptiv Holdings is of course not adopted by all companies. One thing they have announced is also a divestiture of a certain industry branch, namely the EDS branch, and they are going to divest it. This essentially means that now you have Aptiv Holdings, which includes both software and hardware, but they are going to spin off the electrical distribution systems branch. This can be very interesting to follow. EDS as a publicly listed spin-off. The reason why is because there will naturally be a specific focus on the business group with a separate management team dedicated to EDS. And often you see the greatest opportunities arise in spin-offs when it comes to investing, especially because, thanks to that focus, profitability can be increased rapidly in a relatively short time. So it is indeed very interesting. With the upcoming spin-off, the current price target of the stock is estimated at around 80. That is 80% higher than the current price. Quite high. And the highest estimates even suggest a 50% increase in the stock price. Now it gets interesting. So this stock has actually been traded for quite some time, just around its intrinsic value. Only during the coronavirus crisis did a huge discrepancy arise between the EPS development and the price to earnings ratio. And yes, well, EPS decreases, price increases, so the gap only gets bigger, and we see that here in this white area, which is not good. Ideally, the price should be below the fair value line, and in this case, the fair value line is the orange line we see here. The blue line is the normal multiple, which is what the market normally wants to pay. However, in this case, I would take into account the normal, with the price coordinated by the EPS according to the fair value, and that is calculated based on the EPS estimates from analysts. Many analysts here provide an estimate. It all looks good. And Aptiv also caught my attention because it was in one of the screens, in this case from Fast Scripts. It looked very promising, but I decided not to invest myself. Now looking at the current result, well, the price earnings has increased slightly compared to the Dow. That was, by the way, a price earnings of about 6. But here the forward date price earnings is incorporated. The EPS estimates are quite high in terms of EPS growth. Note, there is also a share buyback program included, so the EPS can even increase if the revenue remains the same. And also through optimization, the profits can increase. So those are two factors to increase the EPS. I would personally assume a price earnings of 15. Well, the potential return could then be 32% on average per year for the next 2.5 years. So that's quite a lot. That means a total return of 120%. Even with a lower price earnings, like the current level around 10, you could still achieve an average return of 14%. Well, it looks great, but what could go wrong? Of course, what could go wrong is that in the coming years, the company does not achieve EPS growth. If that is not the case, then of course the bank will not be willing to pay more for it. So the EPS estimates are crucial, and this is where your expertise as an investor comes into play. If you can make a better estimate of this company yourself, or at least align with the analysts, and in this case, there are relatively many, it means that these sources, this estimate here, can somewhat approximate the truth, then yes, it's a no-brainer to invest in it. I haven't done it because I don't know the company well, But what stands out is the factor analysis, which was a hold for a longer time, but has now been upgraded to a buy. And of course, the valuation is relatively cheap. And note, this factor analysis is about relative valuation. What is actually disappointing is the growth, but we already saw that in the management's growth forecast, the metrics are somewhat similar, to last year. Yes, then you can't expect them to grow rapidly. However, profitability is strong, and the momentum is starting to increase, and revisions are beginning to rise. What we see, for example, is that the current price to earnings ratio is around 10, and next year it is expected to be about 11.6. Further adjusted with the PEG ratio, you have 0.5. Of course, a PEG ratio below 1 is very good. If you theoretically have 0.5, you could say you have a 50% safety margin. But of course, it's not that simple. The PEG ratio takes into account the EPS growth for the next 5 years, adjusted with the current price to earnings. So 0.55 is at least cheaper than a PEG ratio above 2 or above 3. And we see this occurring a lot during this period. The sector median alone is already 1.5, but just look at technology, for example. The price to cash flow is relatively low, estimated around 6 for next year, at 7. A small note about the debts. They do have some debts, of course. In the short term, due to the cash position, that seems to be okay, but the market cap is 15 billion. The total debt is relatively large. We see that the price to sales ratio is 0.87 at the moment. So let's round it up to 0.9. So if you multiply the market cap by 0.9, the revenue level, that is, let's round it up to 15 billion. If you have 8.9 billion in debt from that, it's quite a lot. More importantly, it is to check the debt level relative to the EBITDA. Looking at the growth figures, they seem to be disappointing based on revenue growth. Based on EPS growth, we do see an attractive growth of 16%. That is somewhat in line with what we saw here at FastGrab, so that all seems to be well estimated. And I can tell you from experience, this algorithm gives more value to EPS growth than, for example, what is stated here, the revenue growth. All right, then we have profitability, 9%, somewhat in line with 5-year averages. So yes, they are not doing exceptionally well. It's not a great earning model, but a 9% net income margin is okay. Just healthy. The payout margin is okay. And the return on equity is quite on the higher side. But the return on capital is relatively low. And also the return on assets is relatively low. Looking at Zexrank, it gives a hold rating. Their price target, UD, is actually around the same level as the current price. They provide quite a detailed analysis. And actually, the reasons to buy are mainly spread across the entire connected cars market. But for example, also the escalation in costs, although that might not be as bad due to the EPS growth. And what is always good to know is, if you know Peter Lynch as an investor, then you look at charts like the EPS development. And the current price is quite below the EPS trend. This is actually just what we see here as well. It's the same chart, but presented in a different form, and we just see the same consensus. Very often, when many analysts, in this case even more than 20, indicate that EPS is going to grow and management indicates that EPS is going to grow and it all seems to be under the preserved, then let's say 8 out of 10 times it is indeed the case. But of course, you have to be sure that it is so. So I've been following the company for a while, even here at the price level of around 50, which was a very low price level, as it turned out later. But that was even at the price level here from 2016. But anyway, you can only invest your money once, so you have to handle it well. What we are seeing now in the very short term is that the EMA has been broken, the MACD has crossed positively, the suggestions are starting to rise, and the momentum is increasing. So this is actually an early buy signal that we use ourselves. And a long-term buy signal occurs when long-term boundaries are also broken. Looks good. I'm curious to see what happens when it reaches around the price level of 68, 70. Actually, the only reason it will really start to rise faster is, of course, based on fundamental reasons. But you see, a possible comeback might be achievable, and the potential return is attractively high, and we can already see that here through the forecast based on the current price, which is relatively low compared to the EPS. So all in all, Aptiv Holdings is a valuable stock that might be interesting for further research. The second value stock from this video is Pfizer. Pfizer, with the ticker PFE, is of course a well-known company, so we won't look too much into the fundamentals, but there's another reason for that. I avoid anything with biotech or biopharmacy or pharmacy, just not my cup of tea. However, I can show you that Pfizer does have interesting characteristics. And this also applies to other pharmaceutical companies like Illumina and, for example, Merck & Co. Of course, take a look at those as well. The current price target from analysts is significantly above the current price, with about a 20% upside potential. They also indicate, and this is quite interesting, that the lowest price estimate is 25, and that means at least a minimum of 2% downside. We will see this reflected shortly in a bit of technical analysis, indicating that this is essentially the bottom in the very short term. Well, perhaps more interesting to know in terms of information is that Morningstar gives it a 5-star rating, and their fair value estimate is $42. They also indicate, and this is of course important to know, that Pfizer still has a strong economic advantage, or a wide moat. Looking at the historical valuation, that's what this topic is about, of course. For a long time, Pfizer was naturally valued around the fair value. I don't know, the company pays out a very high dividend, around 6 to 7%, so then you can expect a lot of price increase. But due to the coronavirus crisis, that has rapidly increased, and it's evident that the market naturally looks ahead, and the price, after a significant rise, has dropped again. And the question now is whether it has perhaps dropped a bit too far. If we look, for example, at the normal valuation that the market gives Pfizer, it is around 11.4 over 20 years. But the price correlated with the EPS currently gives us a price to earnings ratio of 8, and below we see the EPS estimates, which are not very impressive. However, even if no EPS growth is achieved, Pfizer can still realize returns in the long term simply by returning to the multiple of 11.4, which is the average multiple over the past 20 years, including the high dividend of about 6%. This results in an average total potential return of 16% per year. That is actually quite high. Let's assume that the price to earnings ratio remains around 8, and the price to earnings over the next 3 years is still 8. Then you still have a potential return of around 5%. Why? Because they pay out dividends, which are quite high. So dividends are a big advantage. However, be aware that if these EPS estimates are accurate, then this might indeed be the case. That it is 100% true seems unlikely to me. Moreover, it can also go the wrong way. It could also be that Pfizer ends up deeper in the red than simply by making less profit. Well, and then the decline in stock price will continue further. However, what is very nice about companies with a strong economic moat and also relatively high profitability is that they can benefit from tougher times. The entire pharmaceutical sector is now in a downward spiral, so maybe Pfizer can benefit from this. And if expectations are low with lower EPS estimates, it is very easy to exceed naturally low expectations. So those kinds of psychological reasoning are certainly applicable in investing. However, you must be sure that you are right. And that's why you need to be well acquainted with Pfizer's pipelines, as well as its market position, and of course the future, innovations, and the strategic position of the company. Looking at the current price earnings, it seems a bit on the high side, but for next year it is estimated to be around 11. This is somewhat comparable to what we see here. We look at the EV to sales, price to cash flow. Yes, it all seems to be quite okay. Well, not super cheap compared to the sector, but okay. However, relatively high debts. So yes, high debts are actually never good, even if they are long-term debts. So that's why you need to study the balance sheet carefully. Looking at growth, this model predicts high EBITDA growth and EBIT growth. That's why it also gets a strong buy, due to the combination of factors. So here, we see the EPS growth estimates, so it might turn out differently, but the EPS growth estimate for the next 3 to 5 years is at least also in the factor analysis at 2.5%. This is also more for inspiration because, as you know, I invest on a fundamental level. So the companies I know very well with interesting earning models, I know the companies less well. Let's say I know the company as well as an average person. However, you achieve high returns by investing in companies that you know much better than 99% of the crowd. You will never be the only one with that knowledge, but you can know more than 99% of the rest. Where do you get high returns? Because you can assess much better what those companies are truly worth. The profitability grade is indeed very high. The net income margin is still 12%, but significantly lower than, of course, the 5-year average, even with the coronavirus crisis. But look, they are still generating a lot of cash flow, $500 million. And of course, with 11 billion in cash flow, well, you can achieve something here and there. The analyst gives a hold rating. Their price target is 28 for the next 12 months. The current price is 25, so yes, that's actually not much upside potential. Looking at the EPS chart, the price is actually below, so that's positive. We also saw that reflected here in the fast graphs, and they do provide quite a comprehensive analysis of Pfizer. You can pause the video if you want to read this. Go ahead. Also, the reasons to sell, for example, but we continue. And in a very short-term circuit analysis, we see that the price is dropping again. It could be that a support level is forming around the price of 4.8. But keep in mind, this is purely reading charts, and you should always invest based on fundamental analysis. So that's super important. It falls below that 4.8. Yes, where is the end then? No idea. Maybe at other support levels. I would look at the personalities. I would really look at Pfizer on a fundamental level. Like, what is the pipeline? Will they make more profit in the future? Yes or no? And even if it's only in 3 or 4 years, that's a better position. And of course, only invest in companies with long-term growth potential, because that makes your life a lot easier. In the meantime, you can wait because they do pay a high dividend of about 6% per year. The last value stock for this video is Carnival. I also have a small position in this myself, and we have mentioned Carnival more often. It has since risen again and can still continue to rise. Carnival is a cruise line company, and there are a number of interesting developments at this company, including the macroeconomic trend that there are increasingly more cruise passengers, but also that Carnival is succeeding in making their business more efficient, and, for example, increasing the spending per cruise passenger. So those are all positive developments. I think Carnival can still rise a bit further. Looking at what analysts say, they give a price target of about plus 12%, so a price target of 29%. Looking at Morningstar, they indicate that it has a narrow economic moat. For example, there are also various other cruise ships. Royal Cruiser Ship is one of them, with the ticker RCL. It has been very well priced in the recent period, but it might be that Carnival, being the last to come on board, still manages to realize some returns. The Morningstar rating is 3 stars. We give a fair value estimate of around $30. The valuation has, of course, climbed a bit after the recent price increase. Looking over a 7-year basis, it seems to be just slightly above the fair value. Looking at the forecasting, with the current price earnings that have risen somewhat, it is now above the multiple of 14. However, let's say the 10-year multiple is, for example, 16.5, so it is somewhat around that average. Looking at the fair value, just based on the fair value line, we see that the EPS estimates for the coming period are quite high. Yes, that has to do with a bit of macroeconomics, but also efficiencies that Carnival adds. I believe they also purchased something with the private islands. I don't know all the details. They are doing very well in marketing, so it is definitely worth investigating further. With my current price earnings, it has indeed risen somewhat. Suppose these good figures are true. Then you could end up with a price earnings of 18. Of course, we are a bit more cautious. Let's take the one of 14.6. That means a potential average return of around 11% per year. But of course, it can turn out much higher or lower depending on how things go. All in all, given the strategic position of the company, it seems to me that they can grow in the long term, especially considering the price history of this company. But of course, that doesn't have much to do with intrinsic values. If we look at the factor analysis, we see that it still scores positively in terms of valuation compared to the sector. Note, this is a relative valuation, where the price to earnings ratio for the following year is estimated at 15.3. Well, that's a bit lower than the sector median, which is why it gets a B. Other aspects look good, but what stands out is the price to cash flow, which is positive. Note, high debts. Total debt is, of course, very high for Carnival, rounding up to 30 billion. Yes, that is, of course, a legacy from the coronavirus crisis, so pay close attention to that. The downside is definitely there, especially because it simply involves so much debt. Whether they are short or long-term debts, the lower the debts, the better in most cases. The EBITDA growth looks good. EBIT growth is estimated at 30% for next year, a very peculiar characteristic for the EPS growth, so let's ignore that. Let's look at the profitability aspect. Well, it is starting to climb again now, currently at 107.6%, but it might continue to rise if all goes well. The equity is also starting to increase again, so that's a good sign. Looking at the Zegshenk, which indicates the Holt rating, the price target of the Zegshenk is $29 compared to the current price of $26. Here again, we see that the price is still below the EPS line, which we have seen before. Yes, they mention several reasons for Dubai, including marketing campaigns, which we just discussed, and that seems to be going very well. But also some reasons to sell: rising costs, geopolitics. So, yes, that is, of course, a vanilla argument. Looking at the price, we see that it has recently risen to a significant peak. If you had bought here at the BIP of 2022, you would have had a price increase of 270%. Yes, they really talk about a valuable stock at that moment, but yes, very few people dare to buy it. You also have to follow that stock at that moment and understand it. If you had gotten in a bit later, you could still have achieved a return about 30%, for example. And now it seems that the price has risen quickly, but as we have just shown, there might still be a further price increase possible, especially if you look at the long-term picture and zoom out a bit. Suppose that Carnival ever returns to the Altium high, that still means 150% potential. Well, that really won't happen in the coming years, but never say never. It may be that given its strategic position, Carnival can still achieve nice profit growth for the next 5 to 10 years. However, in this analysis, we have seen that the next 1 to 3 years are somewhat easier to estimate. It could be that there is still upside potential, particularly based on the EPS accrual that we also see estimated here on the screen. So this is the third value stock: Active Holdings, Pfizer, and Carnival, all with possible upward potential. However, a bit of debt can really throw a wrench in the works. But all in all, if you were to invest in these three, let's take a hypothetical example for convenience, each 1%, the idea is that one of them could potentially grow to, for example, 4 or 5%, and then you already have a return. The best thing, of course, is to thoroughly understand what the companies do, and this is purely for inspiration. Every month we share new value stocks. So is there one you like or none that appeal to you? That's perfectly fine. Then we move on to the next month. Subscribe for new stock analyses, also on growth stocks and dividend stocks, and of course our monthly portfolio updates. Thank you for watching and see you next time.